Good morning. Thank you for the honor of being invited to participate in this wonderful conference. It's a privilege to be here. It's also a privilege to have been taking part in a small piece of a much larger research program. I'm going to tell you today about the Payment Diary program. It's a survey and diary program that we've been running at the Boston Fed, not nearly as long as the Townsend Tie, but about 3 years ago, Professor Townsend came to us and said that what we're doing actually has some relevance to what he's been doing, a small piece of the puzzle that we have been working on independently of his project, and then understanding how we fit into his project. It has dramatically changed the way we're doing what we're doing, and so we have been trading ideas and projects, and I'm going to show you today how these two projects are coming together to mutually benefit themselves. The work that I present today is, of course, mostly due to the wonderful work of my staff at the Boston Fed. They're really terrific, and this very much reflects all of their work. But this presentation is only my views and not the views of the Federal Reserve Bank of Boston. So let me start by giving you a short overview of the U.S. payment system so that you have some context of what's happening. And then I will tell you about the Boston Fed Payment Survey and Diary, how they came about and why they are in existence and what we've been finding from them. And then I'm going to concentrate most of my presentation on talking about three types of innovations that have emerged from the measurement of consumer payment behavior through the Boston Fed program. In particular, the diaries are more precise because they are based on recording versus recall, which I'll explain later. They have the benefit of being broader in scope even than the leading U.S. survey of consumer expenditures. And so they have a tremendous ability to capture all of income and consumption in household behavior. And finally, in the work that I've been doing directly with Professor Townsend, we've learned that the diaries have a unique ability to bring about the full integration of the measurement of household financial and non-financial behavior with formal statements of financial statements of accounting for households. And so then I'll finish with a brief summary of some research opportunities with our data and some implications for data collection, which will hopefully be helpful to you. So let me give you a quick brief overview of the U.S. payment system, which might not be familiar to many of you. So we have very little data over time to show you what has been happening in U.S. payment behavior, and that's because for much of the U.S. history, there were really only two main choices. There were cash and there were paper checks. I don't know if you have them in Thailand, but a paper check is about this big, and it's a piece of paper, and you fill out the information about who you pay to and who you pay from. It has your bank account number on it. We put them in the mail, and it's a very labor-intensive process. But cash and check were the primary sources in the United States, except for some credit cards, but the credit cards were, until recent decades, limited to a very small percentage of the population. So this chart shows you that over time, we did not have any estimates of cash use, interestingly, but we did have estimates of the volume of use of checks. That's the red line, and it was trending upward until about the mid to late 1990s, when suddenly we began a shift away from paper checks to electronic means of payment. The main two ways in which we changed were something called a debit card and ACH, which is an electronic payment system, automated clearinghouse system. And so many of the checks that had previously been written were switched into debit card payments or these electronic payments, and you can see that shift in the later part of the graph with the rising debit card and particularly ACH. So there's been a transition from paper to electronic. It's been primarily from paper checks into debit cards and electronic payments. but we have very little information about cash. And what's shown here is just the consumer portion estimated from our survey to give you some idea of what the magnitude of cash is. Most likely, if we had older data, the cash numbers would have been much higher earlier and have come down since the emergence of these electronic methods. The most important feature of the U.S. system has been an increasing and actually increasingly more options for U.S. consumers to choose when they make a payment. So to make a payment in the United States, you need some sort of an instrument to authorize that payment. It may be a check, it may be the currency itself, it may be a card, it may be some sort of electronic means. And now it's increasingly various types of means of payment on a mobile phone. But what you can see is that for a long period of time, it's been the number of options have been increasing throughout much of U.S. history, but the increase has increased. It's accelerating in recent times, and there are more and more options coming available to consumers. So one might think that some of these new options replace the old options, but that's not what we find. Indeed, we find that U.S. consumers are just increasing the number of options that they have available to them. Their wallets, if you would, their wallets are getting thicker over time. So this chart shows you the extensive margin of adoption of different types of payment instruments. And of course, cash is essentially 100% in the top there. And most U.S. consumers have bank accounts, although we're now, as you can see, tracking the difference between having paper checks and having a checking account. This is quite interesting and important. So what's happening is that more and more people who have a bank account now do not have a paper check, and they don't rely on it at all. So that's the main innovation that's related to the earlier slide. As you can see, as you can see, the credit card use or adoption has been pretty flat for a long time in the United States. But the main innovation was the take-up, the dissemination of adoption of debit card use since the early 90s. We don't have data on these other means of payment that go back that far, but you could easily imagine that, like most technologies, bank account number payments, which is when you give your bank account information to a third party, which can then remove the funds from your account, or an online banking bill payment system in which you go onto your online banking account and push that payment out to a third party. Those two means of payment are fairly new and probably were rising from the time that the debit cards were as well, but we just don't have data on that. In the United States, there is something called a prepaid card that has become very popular. There's various forms of them. The ones that are available for general purpose to pay anywhere are becoming the most prevalent. And money orders and traveler's checks, which have been around for a long time in the U.S., are fairly limited. We actually are tracking now virtual currency. You may have heard of something called Bitcoin, so that would be in here, and it is essentially very, very, very small at this point. And finally, in the U.S., you can also make payments directly out of your income. If you direct your employer to make that payment for you, you can have that done. And so these are the main forms of payments in the U.S., and people are adopting them. But the question is, what do they do when they get to a point of sale or when they make a bill payment? They have a choice to use these payment instruments. As I said before, U.S. consumers are adopting more payments, so the number in their wallet has been increasing, and so they have choices at the point of sale at a store, or when they pay a monthly bill. They can choose from any of the instruments that they've adopted. And so here's a picture of the use. The solid lines are from our survey. The dashed lines are from our diary. I'll explain that more later. But as you can see, despite all of the influx of electronic payment methods, U.S. consumers still make a lot of payments with cash. So following the financial crisis, there was an increase in cash use and a decrease in credit card use that has now come back to more normalized. But the debit card and the cash and the credit card are the three most popular forms in the United States, each with about roughly similar magnitudes. and checks are declining, and these other methods that I've mentioned that are more recent still have yet to overtake the traditional forms of cash, credit, and debit. I'll come back to discussing the relationship between the diary estimates and the survey estimates later, but by and large we are believing that the diary estimates are better than the survey for reasons I'll explain. So let me tell you about the survey and the diary. This table, like the one that by the previous speaker, is far too complicated to cover. I just would like you to see that we're comparing the survey and the diary from the Federal Reserve Bank of Boston, the Survey of Consumer Payment Choice and the Diary of Consumer Payment Choice. And we're going to compare the characteristics of those surveys to three different other data sources in the U.S. The first is the Consumer Expenditure Survey and Diary, which also is two similar forms of collecting data. There's a Survey of Consumer Finance from the Federal Reserve Board, which is primarily a balance sheet and income. It collects a lot of income, but it's primarily balance sheet, assets and liabilities, whereas the Consumer Expenditure Survey is primarily about expenditures. There's a Financial Crisis Survey that I won't talk very much about, and then the payment surveys, which are not really intended to be surveys of balance sheets or income statements, but are about payments, and we're realizing that they can be used for these broader purposes. We'll talk. I don't have time to discuss all of the details of these differences here, but the main thing is that our survey and diary are fairly new. They're fairly infrequent. They're small. They're focused on consumers and especially on the payments. And we're just now understanding how that payment choice tells us about income, expenditures, and assets and liabilities. Let me show you how we design our survey and diary, and I'll show you how this compares to the Townsend-Tai method later. So in our survey, which started before the diary, it was just an annual survey that was done in the fall each year. It lasted typically a couple of months, and it was voluntary as to when people could take it. So it was occurring independent of the diary. And then we added the diary to test the quality of the survey. The diary has better characteristics in terms of being able to accurately measure what people are doing as opposed to depending on their memories or their recall. And so the survey was independent, but when the diary went into operation, we had to find a way to integrate the survey and the diary. And what you can see is that we now, in 2015 and beyond, we now insist that the survey be taken first, but when we first did this in 2012, we didn't insist on this, and so some of the surveys were taken after the diary. But ideally, the survey is taken first because it collects a lot of information about the adoption of bank accounts and payment instruments, and then we want that information to be able to use it during the measurement of the diary. But now that we've formalized that, for the most part, the survey will be taken first, anywhere from 1 to 45 days ahead of the diary. And then in the diary, it's primarily focused around a 3-day period. So each respondent only participates for 3 days. And I'll show you in a minute how we fix that with sampling. But any individual respondent only gives their information for their payments for 3 days. In 2015, we added an extra survey the night before to collect some specific information. So it's, in some ways, it's almost a 4-day, but the first day is just a survey based on measuring things and some recall. And the diary is based on recording, writing down everything that you do of every day. And within the diary and period, we're primarily collecting every single thing that people spend money on or authorize with a payment instrument. And we also find out what their balances, their daily balances are on various accounts. And then we have some special modules on some of the days. And so each person is going through roughly a survey of about 30 minutes and a 4-day, essentially 4-day diary, but only 3 of those days are recording actual activity. Now, the fact that we only have 3 days for each person makes it problematic for estimating aggregates. And so we use random sampling to construct daily samples of consumers who are filling out various portions of their diary at different points in time. And so this first chart shows you how we distribute that throughout the course of a month. We typically do this throughout the month of October. And so we'll select the first wave on the 29th of September, the second wave on the 30th, and add it to the first wave. And then we have, on the first day of the official measurement period, we have 3 different waves of people on 3 different days. And we're randomly selecting these so that on each day, it's a representative sample of all U.S. consumers. And then we do that all the way to the end of November. And this gives you kind of an idea of how that has actually played out in practice. This is the number of respondents each day, and the people on day 1, day 2, and day 3 throughout the month of October in 2012. And then in 2015, we had a switch in our survey vendor that caused us to change the sample. In 2016 and this year, this has gone back to just an October survey, but we had a delay, and we decided to spread it out so that we would cover the U.S. holiday period of Thanksgiving, Christmas, and other kinds of holidays. And so we just did this as an experiment, and that's why the sample period ran long. Now, although we've been mostly focused on measuring payments by cash, debit, credit, etc., the one thing that Professor Townsend's work has done for us is to begin to think about how what we're collecting relates to more fundamental economic conditions like consumption and income. And so in 2012, we took the data for all of the payments that we collected, and we calculated, a daily average amount of spending. So in the U.S., the average is about $121 per day. You can see the volatility throughout the month of October. The median is a lot smaller because many payments are very large, and so when those come in, they raise the average. But one of the things that we found that's very interesting about this random sampling of just collecting 3 days of data for one person, distributed statistically properly across the course of the month, is that when we aggregate across all days and across all people, we get an estimate that comes very close to the U.S. estimates of consumption and income. And how we can begin to first see that is this chart on the right shows you the projection of the total amount per consumer spent for the month of October. So the final estimate was $3,678. That's per consumer, per household. And if you look here, the very first estimate on the first day is high. So this is a seasonal high on the first day of the month, seems to be higher than other days because some people receive a lot of income on that day. And you can see that if we based that and we projected the monthly spending, it would be way too high. But as the days go by and the pattern of daily spending starts to smooth out, our projection of the final estimate starts to converge on the actual final estimate. And by a third of the way into the month, we're within a standard error of estimating what actual average income for the whole U.S. consumers is. And it stays there for quite some time. So as a first back-of-the-envelope calculation, we said, gee, I wonder how that number matches up with other data. And so we took that data and multiplied that times 12 to give us a per consumer estimate of $44,000 in the U.S. And then we noted that the average household has 2.01 adults in that household. This is a survey of only adults. So if we do some rough back-of-the-envelope calculations, we get a number of about $89,000 a year of total expenditures. And we said, I wonder how that matches up with U.S. income. And it turns out that from the Survey of Consumer Finances, which is a very, very reliable survey of income, this is the average household income, and this is what's implied by our estimate of U.S. payments. So remarkably, we're very close to essentially covering all of income just by tracking every expenditure that a consumer makes over a 3-day period and using statistical power to get that proper at the aggregate level. So this was very encouraging when we saw this. just to give you some preliminary a peek at the 2015 data. I won't spend a lot of time on this because it's very preliminary and it's more complicated. But in 2015, with the realization of this and this, we took some steps in 2015 to improve our ability to measure consumption rather than just payments. I'll show you in a few minutes how payments and consumption are related, but they're not exactly the same thing. And in 2015, we took steps in our survey, in our measure, to make sure that we knew what payments were consumption and what payments were not consumption. And so this shows you the outcome of that. I believe this is a typo. That should only be $35. But in 2015, we have an average of $150 per day. I think that's partly because we had better coverage, and the median was, I think, 35. But now we can actually, with some degree of confidence, distinguish between a payment expenditure and a consumption expenditure, consumption being a subset of payments. And as you can see, the consumption number is below the payments number. So the difference between that is stuff that's not consumption, but is tied to the use of a payment instrument to transfer assets to some other means. We did the same exercise over here, and this is very recent that I've even seen this myself, so I don't have a lot of interesting things to say about it quite yet. You can see that we don't have the same pattern that we did in October, but that's because we're starting in the middle of the month in October rather than at the beginning. But the same idea holds, that within a very short period of time, we're converging on a total estimate. Now, this total estimate is smaller because this is consumption and not total payments. So this is not going to be related to income. It's going to be related more to consumption. So we do the same back-of-the-envelope calculation for consumption, and we find that we're getting a back-of-the-envelope estimate of aggregate average consumer U.S. consumption of about $68,000. And we compare that to the Consumer Expenditure Survey. It's higher, and I'll explain to you why that is later. But then we look at sort of an average marginal propensity to consume out of the income that we've estimated. We get 81%, and in the national income accounts, the average marginal propensity to consume is 79%. Again, these are remarkable results because we didn't set out to estimate these things. They just came out of tracking payments. Now, with that set up, let me explain the innovations. So the first thing I want to tell you about is the increase in precision of the way we're estimating these economic concepts. And I first want to show you how recall-based surveys collect data on expenditures. On the left-hand side is a tiny snapshot of a really long survey from the Consumer Expenditure Survey in the United States, which is viewed as the leading source of consumer expenditure data at the individual level or the household level. And on the right-hand side is this more recent financial crisis survey that used the same panel and online survey methodology that we use for our Boston Fed survey and diary. And you can see that from these two surveys, they emphasize the ability, or they rely heavily on the ability of the respondent to remember what they did in the past. So in the Consumer Expenditure Survey, they're asking, for example, what has been your household usual weekly expense for grocery shopping? All right, so if you just stop and think about your last week of grocery shopping, can you accurately recall how much you spent on your grocery shopping in the past week? And then it's not just the past week, it's asking for the usual week. Okay, so this is a very memory-dependent process. It does not ask or require the individual to check records of how they did this. It's just asking them to remember. In the financial crisis surveys that I mentioned before, this is now the amount spent during the last month, and here's some categories: food and beverages, dining, drinking out, gasoline, other transportation expenses. So this is a very common way that data are collected, and I believe even some of the Townsend Thai data are collected in this way. But it's asking people to remember amounts that are aggregated over time periods that are sometimes as long as a month or even a year, and they're aggregated across expenditures. So when you think about groceries and you have a basket, you have dozens of products inside of there. So you're having to add up a lot of things. Now, diaries are a different form of collecting data. A diary means that you take along some sort of a device, it could be electronic or paper, but you write down as you go how much you spend. And there's two examples here. The one on the left is from the Consumer Expenditure Survey, and the one on the right is from the Boston Fed Diary, the first one from 2012. I want you to notice that both of these are collecting a fair amount of detailed information. In the Consumer Expenditure Survey, it's actually asking for the total cost of each individual type of product, very, very detailed, and it's for a particular day, and it's for a broad category, but it's asking for every single product in that category to be recorded on that day. So if you brought home a shopping basket of 100 items, you would have to fill out 100 items. In the Boston Fed Diary, it's still a particular day, and it's still asking for the amount spent, the time at which it was spent, the payment method that was used, which are these here, the location, whether it was in person or not in person, the device over which it was conducted. It could be a computer, but it could be nothing if it's in person, and the merchant type and name of the person of the store that was paid. The key difference here is that this amount spent, if we had been representing this shopping trip, would have been the sum total of all of this in this here. There'd be just one number to record as opposed to 10 numbers. It turns out to be one of the key characteristics of the success of the payment diaries, is the aggregation across products to a higher level of payment, which is a larger number. It doesn't have all of this rich detail, which the government in the U.S. needs in order to formulate price indices and other things. But it captures a total of all those things, and it reduces the number of things that people have to track from literally hundreds down to about 60 per month. We find that the average person makes 2 payments per day, and so it's a much smaller burden on the respondent. Now, here's a comparison of how this applies to the Townsend Tie project. So from 2001 to the present, this is a comparison of recall versus recording. From 2001 to the present, the Townsend Tie was asking, since the last interview a month ago, have you or members of your household made any cash purchases of any of the items in this category? And if yes, what is the total amount that you and members of your household have spent on the items in this category since your last interview? So this question is very similar to these kinds of questions. It's based on the household's ability to recall their cash payments. In contrast, the diary is actually each day getting an estimate of the total expenditures, X, for each day. And so the surveys are asking to remember all of this back here and sum it up. And so they're giving a total estimate out of their heads, whereas the recording method is taking all of those and summing them up over the 31 days. And in general, survey research finds that those recall-based estimates are typically smaller than the sum of the individual estimates. And this is also an important part of the precision of payment diaries. Now, in part, I think, because of his work with us, Professor Townsend has been directing his team to begin to implement daily cash recording, given the amazing success of the Boston Fed program. Let me just show you one quick example of how successful this has been, much to our surprise. There's citations to the papers where you can read more about this on the last slide of the presentation. But this is a comparison now of aggregate consumer expenditures, not consumption, but consumer expenditures, tracked by the diary in this column, and the Consumer Expenditure Survey, which is the primary U.S. government survey. And you can see for the total, the diary estimates 2.7 or 10.8 billion dollars of consumption for the month of October, and the total for the Consumer Expenditure Survey is only 60%, 59% as high as what's being collected by the diary. This is a remarkable increase over the magnitudes that are produced by the main government survey. And what you can see from this yellow box is that it is not the survey feature, I'm sorry, it's not the diary feature that leads to the success, because the Consumer Expenditure Survey has both a survey and a diary component. But when they tabulate their estimates for these basic categories, they're coming up with the survey and the diary with a number that is still much smaller than what the Boston Fed diaries are collecting. So while diaries are indeed more precise in terms of what they collect, they're not necessarily better at covering all of the expenditures. And that's where the payment approach of aggregating expenditures is more successful. Now, let me build off of that by saying that this greater success in coverage broadens the scope of our ability to measure household or consumer economic activity. And here I'm going to, unfortunately, I'm going to bore you with a few slides of equations. They're not as complicated as White's equation, but nevertheless, if you're not an equation person, now's the time to check your email. So we want to understand what we're collecting with the payments. And the best way that I thought to do this was to just compare at a very simple high level some definitions from basic economic theory of what the difference between income and payment is. So we know from economic theory that income is simply consumption plus taxes plus saving. Well, so we start with payments and think about payments associated with consumption, payments associated with taxes, and payments associated with saving. But it's not exactly the same. It's similar, but it's not exactly the same. One way in the U.S. is that when we collect your payment information, we're not separating out the sales tax. So the sum of the T in income is actually in the XC for payments. We can easily correct for that fairly well, at least at the aggregate level, not at the individual level. But the more interesting and complicated type of payment that we had to think hard about is what's called a saving payment. And I'll explain that more as we go into the financial statement portion of the talk. But basically the way to think about it is that you can use a payment instrument, many of the ones I've discussed already, plus others. You can use a payment instrument to transfer assets from one form to another, and that's not consumption, it's not taxes, it's just transferring assets. And so if that occurs during the income period, then it is really still saving, even though it's a payment that we picked up. So it's basically we picked up a piece of the saving, and we picked it up only because we're tracking the changes in assets that have been motivated by payment instruments. So that's one example. Another is when a payment is made to reduce a liability. So for example, when a payment is made to pay back credit card debt, that payment itself is not consumption, even though the credit card spending that occurred may have been consumption. The repayment of that debt is not. So that's another example of a saving type payment that we need to be careful to track when we do this for national income purposes. So simply explained, the difference between income and payments is, by and large, is the unmeasured change in net worth. And so because we're a payments survey, we weren't trying to get the entire balance sheet. So people could have made payments out of certain types of assets that we're not tracking. That's the part that's different for us from income. Now, there's also a whole host of measurement issues, and by the way, the speakers so far, none of them have pointed out to you that the measurement of this stuff is extremely difficult. When you're in the field, figuring out what goes into what cell and what box and how much it really is very hard. But at a very high level, let me help you see, just from what we're doing, what some of the challenges are in terms of measurement. So for example, when we compare income and expenditures, payment expenditures, we're coming at that from different sampling sources. We have different surveys, and so the measures are made differently, and there are a host of measurement errors that'll be different, which might be correlated, but we really have no way of identifying that. When it comes to national income, I think this is a bigger problem in Thailand than it is in the U.S., but there are undocumented expenditures. These are sometimes called the shadow economy, or there are other terms for it, but this would be exchange of, say, services that households would engage in that's not covered by government sources, not documented in income, doesn't pay taxes, it's avoiding those things. Those are not going to be in national income, but because we're asking people without telling them that we're checking up on them, we're asking them to tell us everything they paid for, they very well could be telling us some things that they're paying that are not recorded. And so the diary could actually, in some ways, generate higher estimates of expenditures. We have to take that into account. And a third piece of the puzzle that's very hard in terms of measurement is that in the U.S., much of income is deducted before it's deposited into your bank account. So employers will pay some consumer expenditures for them indirectly. They'll also provide benefits, such as health insurance, for example, that are deducted from the income that would have been paid if it was a private payment that individuals had made. So in order to fully measure everybody's expenditures, we need to know the third-party payments that are being made for consumers. That's a whole nother level of difficulty in measuring consumer expenditures. Nevertheless, we can do a rough comparison of disposable income from the national income accounts and our estimate of total payments, and adjusting for all of those measurement issues as best we possibly can, this is what we come up with. We find that disposable income from national income sources is about $12.4 trillion, and when we make the adjustments necessary, we get down to 10.2. And our consumer payments estimate was 11.2 trillion, and with the adjustments it comes down to 10.7. So the ratio between total consumer payments and disposable income, as much as apples to apples as we can do in 2012, we find that the two sources are remarkably close to each other at the aggregate level. So that means that just by asking people to write down everything they pay for, we're getting close to a complete accounting of all income coming into the household. This is pretty remarkable. In 2015, we made another adjustment, which was to go directly after estimating income sources. So in 2012, we never asked how much income you got. We had a question that asked about total household income, which most surveys always have. But we never asked the individual, how much income did you personally receive during that period of time? In 2015, we tried to do that. It's another additional question. It's much harder. It's potentially more invasive in terms of privacy, so we weren't quite sure how it would turn out. But we asked them to just let us know during those 3 days, did you receive income deposited into your bank account or in cash or in any other source? And just tell us the net amount that you received. We didn't try to figure out those third-party expenditures. We just said how much was deposited into your bank account for income. And here's a picture of, for 2015, daily income and expenditures from our diary for all U.S. consumers. This is now the direct measure of income. And this picture, I was watching White's presentation, and I showed Rob this picture. I said, this looks an awful lot like your individual household pictures, although it's smoothed over all households. But here's income fluctuating a lot, and expenditures, which we can identify exactly the consumption component, much smoother. More remarkably, I think, we look at this, and the average income daily was $104, and the average expenditure $80, and this is now net income, and it's the expenditures only made directly by consumers themselves. But again, we come up with an average marginal propensity to consume that's remarkably similar to aggregate data. Finally, there's a third benefit or innovation from our diary measurements, which is better integration. So those of you that are familiar with the Townsend tie methodology, and in particular with the monograph that Chris and Rob wrote back in 2010, you know that the basic idea is to advocate designing surveys, and in this case, payment diaries, designing them in such a way as that what they collect for expenditure information and income information and assets explaining household and consumer economic activity, integrating those surveys and diaries exactly with the elements of a household financial statement that follows the framework used by corporate financial statements. And this picture shows you the basic idea, which has already been shown in the previous presentation to some extent. But we have a balance sheet with current and long-term assets and liabilities and an implied net worth. And that balance sheet is connected to the flows. These are our stocks, and the flows are the income statement. And that gives us a consumption dividend, and whatever's left is a savings that should show up back in the balance sheet in the next period. As the TTMS, or the Townsend Tai monthly survey, does it, there's an initial survey that generates an initial balance sheet estimate, and then a resurvey that updates that once we have the income statement and cash flow statement. So what we decided to do in a paper recently that's coming out in Economic Inquiry was to take that basic idea of integrating measurement with financial statements and see how U.S. surveys do with regard to integration. And so this picture actually summarizes half of the paper very simply and easily. This is a scatter plot of two dimensions of measurement. There's the balance sheet measurement here from 0 to 1 and the income statement measurement from 0 to 1. And this is a proportion of the balance sheet and a proportion of the income statement that is covered by the estimates from these leading U.S. surveys. So there's two types of coverage. There's a coverage by category and a coverage by amount. What do these mean? Coverage by category means if there were, say, 20 items in a balance sheet, the coverage by category would tell us the proportion of elements in the survey that are in that 20 items on the balance sheet. So let's say a survey collected 10 of those 20 items, they would have a coverage ratio for categories of 50, 0.5, okay? And likewise, for the income statement, we figure out how many categories of income, how many categories of expenditure are in an income statement, and how well are they covered, and that's here. By amount simply weights those categories by the dollar amounts covered. Now, interestingly, if there's 20 categories, you could do a simple recall-based estimate, which is tell us the total amount for those 20 categories and just ask one question, or you could conceivably ask all 20 questions and then sum those up. And so the value tells us how close to get to covering all of the dollar value in the financial statement. And the most important thing to see here is that while there are some surveys that do relatively well, both in terms of the items and the value of covering balance sheets, they're getting over 75%, the income statement is not very well covered by many of the surveys. The highest is about 50 or 60% by value. So the bottom line to this is U.S. household surveys, which are generally viewed as among the best in the world, are a long way from implementing the integration idea of Townsend and Chris. So I'm not going to show you the balance sheet and the income statements individually. You can see those in the paper. But I want to focus on what we think is perhaps the most important innovation in thinking about how the payment diaries connect to that coverage issue. By the way, I forgot to mention that you can see that we don't cover very much in the payment surveys, although once you weight them, we do pretty well on income and about half of the balance sheet. So the payment surveys were not designed to do what Townsend Tai does or these other surveys, but we do reasonably well. The thing that the payment diary does really well on is in the linkage between the balance sheet and the income statement. And this is accomplished by this simple equation where we think about any stock, X, any asset or liability on the balance sheet and how it moves over time. It starts with where it was last period, and then it changes by the total amount of deposits into that account, whether it's an asset or a liability, the deposits into that account minus all of the withdrawals from that account. Now, this is emphasizing that when you do a payment diary, you're tracking every single day. There's a whole nother level of integration that I'm not covering here, which is that within a day there may be multiple types of deposits, and within a day there might be multiple types of withdrawals that are related to those line item coverages we just talked about. But just for now, I'm emphasizing the recall versus the recording. Okay? And so incomplete integration means that we're not estimating any of these things. If you have estimates of D and W, you could infer what the change in X is, or if you have estimates of the change in X, you could infer what the net deposits and withdrawals is. That's not complete integration either, because complete integration requires measurement of each of these items. And measurement of each of these items is important because as you measure them, you can discover errors. And so one of the challenges that I understand from Rob about the project has been there have been inconsistencies that crop up over time in the implied relationship here from the estimates that are gathered, particularly in measuring the stock of currency held. So these are some detailed summaries of cash flow statements, which I won't go over with because I'm running out of time. This is just how the U.S. surveys work out, and I just want you to see that we're measuring the percent errors that surveys are making because of their lack of dynamic integration are pretty high. And then we did the same thing for the Townsend Thai data and the diary for October of 2012. Not surprisingly, the U.S. estimates of income are much higher. And we can calculate internal cash flow errors, but not for the Townsend Thai data because they were not actually collecting each of the pieces of that dynamic equation. But the diary doesn't do exactly very well because it's not capturing every piece of that puzzle. But the final piece of this that's really quite, I think, innovative and potentially useful going forward is how these payment diaries can be used to improve the precision of that measurement of cash flow. And it comes from the fact that payment instruments are linked to types of assets and liabilities on the balance sheet. And that's what this table shows you. So there's different types of currency. There's different types of there's checking accounts, but there's different payment instruments that can be used to withdraw or pay funds from those accounts. So once we know the payment instrument, we know the type of account that it's linked to. And because of that simple fact, because we're tracking payments by the payment instrument for each and every transaction, we can then map those payments made by a payment instrument back to their accounts. And so this statement of account flows, which you can look at more at your leisure, expands the standard statement of cash flows by allowing us to track where those flows are coming from, which type of asset and which type of liability. And so we can look at, for example, consumption expenditures in the U.S. in 2012 were coming primarily out of demand deposit accounts, so out of bank accounts, checking accounts, and from currency, and from, in this case, credit cards. We can see that the total flows of payments, of consumption expenditures, and how they come out of each asset. And at this level of granularity and detail, the research opportunities, I think, are immense. So this is a very high-level summary of what we've done so far in economics and finance, in public policy, and in survey methodology that can be done with these data. But the one that's largely untapped at this point are the mapping of this stuff to consumption income, saving, budgeting, financial planning at daily frequencies. And so that's really where we can explore those things. So the last thing I have to say is that if you're thinking about how would we design an optimal set of household data, there's three basic principles so far that I can mention. One is that it's crucially important to draw representative samples, and the previous presentation illustrated that a lot. And the second is to make sure that those questionnaires are perfectly integrated with the financial statements. And then the use of various types of mixed mode strategies, which is what the payment diary does, are essential to capturing that data. So this is, again, as I said, you can look up more information here, but this is a summary of what we've learned from payment diaries and how they apply to household economic behavior.